Hello and welcome. Let's discuss how to report solo 401k contributions on your tax return. Specifically, this is geared towards businesses who are taxed as a partnership, filing the Form 1065. Thank you so much for joining. If you have questions or topics you want to discuss, please chat those over. And we'll take those questions after we go through some slides here. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. We also like to highlight that there's lots of resources. For example, we have our community. We've got over 30,000 members. It's a vibrant community with folks posting in the forums. You can post 24/7 in the forums. We also go live twice per day, once at 10 a.m. Pacific, 1 p.m. Eastern. Then we're back again at 1 p.m. Pacific, 4 p.m. Eastern. This is our afternoon session. So you can subscribe to the YouTube channel. Just hit subscribe and hit the notifications bell. You'll get the notification. You can jump on. You can ask questions, hear what other people are asking. So it's a great venue to learn, to share the knowledge. For example, tomorrow we'll be back to discuss custom solo 401k plan, why it is necessary. In the morning session, in the afternoon session, we'll be discussing cheat code, how to make retroactive solo 401k contributions. So we love to talk about these topics. So again, if you have a question, please don't hesitate to chat it over. But we'll jump into today's topic, which again is how do I report solo 401k contributions on my tax return, specifically geared towards a business that's taxed as a partnership. So to put it in context, a solo 401k is a retirement plan that's specifically geared for self-employed individuals. In other words, those individuals that are reporting earned self-employment income on their taxes. They don't have any employees, W-2 employees working for any business. So no non-owner, non-spouse, full-time W-2 employees working for any business that's owned by them or a spouse, if any. If yes, the individual can set up a solo 401k. And a solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. And in the words of the IRS, that's because you can make both employee as well as employer contributions. And then if you have a plan like ours that allows it, you can make pre-tax contributions, which have the benefit of reducing your taxable income now for the year for which you make the contribution, as well as Roth contributions, which are made on an after-tax basis, but have the benefit of tax-free growth. I said potentially because you'd have to have a qualified Roth distribution in order to be able to take out the gains tax-free. In other words, once you've had the plan for at least 5 years and you're at least age 59 and a half or older. And then on top of that, our plan also allows for mega backdoor Roth contributions. So the way that one makes mega backdoor Roth contributions is by making what's called voluntary after-tax contributions. The voluntary after-tax contribution limit is higher than the Roth contribution limit. So for example, for 2025, if you have the self-employment income to justify it, you can contribute up to $70,000 as a mega backdoor Roth contribution, or even more if you're age 50 or older. If you're age 50 or older, you could go up to $77,500 or even $81,250 because of the super catch-up contribution limit, with all of those funds in a Roth account where you've got that potential for tax-free growth. So given that, our customers are able to make all these different types of contributions, we want to talk about how do I report any of those contributions? How do I report all those contributions? Again, specifically geared towards a business that's taxed as a partnership. That means a business that's filing a Form 1065. So now let's continue to drill down on this good topic of how do I report solo 401k contributions on my tax return, where I'm filing a Form 1065 because my business is taxed as a partnership. I receive a K-1 from my self-employed business. Well, if you're making pre-tax employee contributions, then that needs to reduce your taxable income right? Because you're making it on a pre-tax basis. The benefit is the individual is reducing their taxable income now. In other words, for the year for which they're making the contribution. So mechanically, the way that it works is that pre-tax employee contribution will be reported on line 16 of Schedule 1 of the 1040, as well as line 13 of your K-1 using code R, right? Because a partnership is a pass-through entity. So the income flows through to your 1040, and then if you make that pre-tax employee contribution, you'll reduce your income by entering an amount on line 16 of Schedule 1 of your 1040, specifically the amount of that pre-tax employee contribution. For 2025, that could be up to $23,500. Plus, if you're age 50 or older, another $7,500. If you got the self-employment income to justify it, or if you're age 60 to 63, another $11,250 instead of the $7,500, because that's the super catch-up contribution limit. Now, if you're making the employee contribution as a Roth contribution, that means it's being made on an after-tax basis. That means it's not reducing your taxable income now for the year for which you're making the contribution. Instead, you got that potential for tax-free growth. So our plan does allow for Roth employee contributions. Now, if your business is taxed as a partnership, there is no place to report Roth employee contributions. So it's NA in terms of the answer to the question of how do I report solo 401k contributions on my tax return, specifically if it's a Roth employee contribution, NA. There's no place to report it. Now, if it's a voluntary after-tax contribution, voluntary after-tax contributions are a type of employee contribution. If your business is taxed as a partnership, likewise, there's no place to report that on your personal or business tax return. So just like with the Roth employee contribution, it's NA in terms of how do I report voluntary after-tax contributions on my tax return where my business is taxed as a partnership. There's no place to report it. So when you make that mega backdoor Roth contribution, it's a two-step process. You first deposit to an after-tax account, and then the funds are moved either to a Roth solo 401k or a Roth IRA. So that first step, as we're learning, is not reportable. But the second step, when you move the money either to a Roth solo 401k or a Roth IRA from that voluntary after-tax solo 401k sub-account, that second step to transfer to a Roth, that is reportable. But that it's not, so the contribution, the first step is not reportable, but instead the subsequent step to transfer is reportable. So that subsequent step is reportable on a 1099-R. So we handle that 1099-R for our customers as an optional free service, right? For those, in other words, no additional charge for those that request it in a timely fashion. We make it easy to request it. We have an online form on our website that customers use to provide us the information we need to prepare the 1099-R. If you go to mysolo401k.net/forms, you can see that online form. There's one form for after-tax to Roth solo 401k. There's another form for after-tax to Roth IRA. So now let's turn to the other type of contribution. Remember, in the words of the IRS, individuals can make both employee and employer contributions because they're both the employee and the employer when it's their own business, right? If a solo 401k is for self-employed individuals. So if you have a plan like ours that allows it, you can make both employee and employer. So in terms of how do I report employer contributions on my tax return, where my business is taxed as a partnership? Well, regardless of whether it's a pre-tax or a Roth employer contribution, it needs to be reported as tax deductible on the employer's return for the year for which the contribution is made, right? With Secure Act 2.0, it now allows for plans to allow for Roth employer contributions, and our plan certainly does. Historically, employer contributions are always pre-tax contributions. But now, our plan, like other plans that are out there in the market, some, right, the discount brokerage firms don't offer plans that allow for employer contributions to be made as Roth contributions, but our plan certainly does. But per the IRS guidance, per IRS Notice 2024-2, regardless of whether the employer contribution is made as a pre-tax contribution or a Roth contribution, it still needs to be reported as tax deductible on the employer's return for the year for which the contribution is made. So that means it goes on that same line, that line 16 of Schedule 1 of your 1040, as well as line 13 of your K-1 code R. Now, if it's an employer contribution that's made as a Roth contribution, it does ultimately need to be made on an after-tax basis. So even though it's going to reduce the income as an employer contribution on the employer's return for the year for which the contribution is made, it needs to be taxable to the employee for the year for which it is deposited. Now it becomes taxable to the employee by a 1099-R being issued to that employee from the plan. And again, we handle that 1099-R as an optional free service for our customers. In other words, no additional charge for those that request it in a timely fashion. So sometimes the contribution is made for 1 year, say 2024, but it's deposited in the subsequent years, say 2025. And that's because the contribution deadline for these employer contributions is the business tax return deadline, including any timely filed extension. So there's many customers, for example, who are now here in 2025 making 2024 contributions. So if that employer contribution that's being made on a Roth basis is deposited in 2025, but made for 2024, it will reduce the taxable income on the 2024 tax return, but then raise it on the 2025 tax return via that 1099-R issued to the employee. So that means they're going to have to add that as income for 2025. So it creates that unique situation where it's reported in different years. So hopefully that helps answer that good question of how to report solo 401k contributions on my tax return for a business tax as a partnership where I'm filing a Form 1065. So as mentioned, we love to talk about these topics. Thank you so much for bringing the questions. Now let's go to the questions that we've got. If there are additional questions, please don't hesitate to chat that over. We always appreciate the chance to discuss these topics. And if you're finding this helpful, it would be great if you would please like on our YouTube channel, as that helps to get the word out. And again, please subscribe on the YouTube channel, and then you'll get the notifications. You can join the daily session, ask questions. You can also find the schedule at mysolo401k.net/webinar. So if you sign up there and enter your email, then you'll get an email with the recording after we're done if you can't join the live sessions. That's another place to participate. So question 1, I just opened my solo 401k at Fidelity, 3 accounts, Roth, pre-tax, and after-tax. I'm trying to figure out the process of funding my Roth at Fidelity via Mega Backdoor Roth. Do you know if I'm just deposit the funds from my S-Corp directly into my after-tax account? Yes. So as we discussed, it's a 2-step process. First, you deposit into the after-tax account, and those funds can come from the business account or the personal account. Either is acceptable from a solo 401k perspective, regardless of the type of contribution, right? What's most important from a solo 401k perspective is that the contributions are within the limits by the deadlines deposited to the separate account for after-tax funds. And then step 2, move the funds from the after-tax account to the Roth account. All right, so I want to pull up a procedure page on that, just to give you some resources here. Thank you so much for the good question. That's a great question. So here's our procedure page on making those Mega Backdoor Roth contributions. Now let's go to question 2. I have IRAs and Roth IRAs at Merrill. Can you please confirm if that's okay, or do I need to bring those funds in my Fidelity account to be able to do the Mega Backdoor Roth? Great question. So the answer is no. One doesn't have to transfer their IRA to the solo 401k to facilitate the Mega Backdoor Roth. Keep in mind, you can transfer pre-tax IRAs, traditional IRAs, to the solo 401k. One cannot transfer a Roth IRA to any type of 401k, including a solo 401k, and that's because of those Roth IRA rules. So you can transfer the pre-tax, you cannot transfer the Roth, you don't have to transfer any. And I think what you're alluding to is the pro rata rules. So some individuals will have experience with making a backdoor Roth IRA contribution, where one has to consider the pro rata rules, and those pro rata rules apply at the across all the IRAs that the individual participates in. So they got to look across all those different IRAs. Whereas with the solo 401k, the pro rata rules apply differently. They apply at the account level. And here's a video where we talk about that, FYI, about how those rules apply differently. So that means that one can just move the after-tax funds in their solo 401k in that after-tax account over to a Roth solo 401k or a Roth IRA, and they could ignore the fact that they might have funds in the pre-tax solo 401k or the Roth solo 401k, or even in other retirement accounts like pre-tax or Roth IRA accounts. Hopefully that helps. Now, the other link I was going to send you is back to the contribution question. Here's a page on our website where we talk about all the different options to fund that Fidelity account. Because I think you were saying that you have accounts at Fidelity. So perfect. So great questions. Thank you so much for bringing it. All right. Next question. I make contributions to both voluntary after-tax and Roth bank accounts for my $7,500 makeup catch-up contribution. Can I roll both of these accounts directly to my personal Roth? So when you say personal Roth, I'm understanding your Roth IRA. So yes, you can transfer voluntary after-tax funds out of the solo 401k to a Roth IRA. But no, you cannot transfer Roth solo 401k, say employee contributions, out of the solo 401k to a Roth IRA until you've met a triggering event. Because anytime you're moving money, and here's a procedure page that talks about the whole after-tax to Roth IRA. But as far as the catch-up contributions, right, that goes directly to the Roth solo 401k. So when you make catch-up contributions, you don't make those as after-tax contributions. They're either made as pre-tax employee or Roth employee. So anytime you're talking about transferring funds out of the solo 401k, even if it's going to another retirement account, you got to consider the distribution rules. And you generally can't transfer funds out of the solo 401k, even if you're going to another retirement account, until you met a triggering event, such as being age 59 and a half or older. Here's a page that talks about those triggering events. So one exception, though, to that general rule is voluntary after-tax funds. That's why you can transfer the voluntary after-tax funds out of the solo 401k to a Roth IRA. But the Roth employee contributions, one would have to meet a triggering event before they transferred those out to a Roth IRA. Great question. Thank you for bringing it. Do I get separate 1099-Rs from you for my rollover to my personal Roth from my after-tax bank account, or from my Roth bank account and my voluntary after-tax bank account? Is that the only reporting I need to do for these? So again, you got to meet a triggering event, but yes, it would be separate 1099-Rs that we would issue. And again, we handle that so if you are eligible, then you could, and then if you let us know about those transfers, then we'll prepare the 1099-R accordingly. Great questions. Thank you for bringing it. If you have an IRA rollover, can you transfer this to the Roth 401k? Great question. So as we had talked about in one of the earlier questions, if you have money in a Roth IRA or after-tax money in an IRA, it cannot be transferred to any type of 401k, including a solo 401k. That's because of those IRA rules. But if one has pre-tax money in an IRA, then it most certainly can be transferred to the solo 401k. It would have to go into the pre-tax account. And then once the money's in that pre-tax solo 401k account, the individual could do an in-plan conversion where they move over money from the pre-tax solo 401k to the Roth solo 401k. Now, of course, that's going to be taxable as well as reportable. And we would prepare the required 1099-R as an optional free service. In other words, no additional charge for our customers. They just have to let us know in a timely fashion, and then we'll prepare it. Here's a page on our website that talks about that in-plan Roth conversion. So it would be a two-step process. So yes, it could be done if it's coming from a pre-tax IRA to the pre-tax solo 401k, step one. Then step two, once it's in the plan, going from a pre-tax status to a Roth status as a taxable as well as reportable transfer. Same question. If your salary is, say, $50,000, but you have earnings from the S Corp business, can you move these funds into your Roth 401k? Great question. So really, one is asking about, can you contribute more than your salary? Can you use some of the income that you receive as the owner of the business to contribute? And the answer is no. And the reason for that is that the way that I think about it is that all 401ks are really for those who work to save for retirement, those who have earned income to save for retirement. They're not for those who have investment income or owner income to save for retirement. And a solo 401k is for a self-employed individual. So that self-employed individual would need self-employment income to justify their contribution. Now, if you have a business that's taxed as an S Corp, self-employment income is earned self-employment income is the W-2 wages that one receives from their S Corp. And you can't save more than you earn to the solo 401k. So if the wages are $50,000, one can't save more than $50,000 to their solo 401k. You can't use that owner income to justify contributions to the solo 401k. To be clear, my deposits into my voluntary after-tax bank account and after-tax Roth accounts both came from my personal checking account, not my LLC S Corp bank account. Is that correct? So this confirms that when one makes contributions to the solo 401k, they can make those contributions from their personal account or their business account. From a solo 401k, either is acceptable. And that's for all types of contributions to the solo 401k, whether it's employee, employer, or after tax. Thank you for the good question. What year-end IRS forms do I need when I fund my solo 401k Roth, pre-tax solo 401k, mega backdoor Roth? Well, contributions to the solo 401k are not reportable by the plan, right? Contrast this with contributions to an IRA, where the IRA provider needs to issue a Form 5498. Form 5498 does not apply to a solo 401k. A solo 401k can't file a Form 5498, and there's no analogous form. So contributions are not reportable. So whether one makes pre-tax solo 401k contributions, Roth solo 401k contributions, or voluntary after-tax contributions, none of those contributions are reportable by the plan. Now, they may be reported on the personal or business tax return, and we talked about that in the content at the beginning of this session, right? Now, but when one makes a mega backdoor Roth contribution, it's really a two-step process, right? They're first depositing into the after-tax account, and that contribution, again, is not reportable. And then they're moving either to a Roth solo 401k or a Roth IRA. So that second step is reportable, and we prepare that required 1099-R that needs to be issued to report that after-tax to Roth transfer as an optional free service for our customers. In other words, no additional charge. They just need to request it in a timely fashion. It's easy to do that because we have an online form that customers use, mysolo401k.net/forms to access those forms. Now, that after-tax to Roth transfer is reportable for the year of the transfer. So because of the contribution deadlines being the business tax return deadline, including any timely filed extension, many individuals here now in 2025 are making 2024 contributions. So if one's making a 2024 voluntary after-tax contribution here in 2025, when you transfer it to the Roth, that of course will necessarily be in 2025 or even later. So it's not going to be issued, the 1099-R would not be issued until the year of the transfer. So if you transfer it in 2025, even though the contribution was for 2024, the 1099-R will be issued for 2025 by February 2026? Great question. Thank you so much. Can you provide these links more slowly and there's still confusion? So can you go over the Mayur's question again? Definitely. Thank you so much. So the first question is whether you can just deposit the funds from the S Corp directly into the after-tax account. Answer is yes, because as we talked about, one can transfer from the personal or the business account. Either is acceptable from the solo 401k. The second step is then you move the money from the after-tax account to the Roth account. And that's where we sent those links. Let me get that link again here. I think it didn't come through exactly correctly. Thank you. Let me just verify it. Here's the first link with the procedure to go from the after-tax to the Roth. Give you a moment to grab that. Okay, now let's go back to Maur's second question. So the second question is, I have IRAs and Roth IRAs at Merrill. Do I need to bring those funds into my Fidelity account to be able to do the mega backdoor Roth? And here the answer is no, because the pro rata rules apply differently to a solo 401k versus an IRA. Like with an IRA, you got to clear out your IRA funds, right? Any pre-tax funds, for example, in your IRA before you make that backdoor Roth IRA contribution because of the way that those pro rata rules apply. But with the solo 401k, those pro rata rules apply at the account level. So you don't have to worry about that. You don't have to move over your IRAs to the solo 401k. And you can't move over Roth IRAs to any type of 401k, including a solo 401k. So you don't have to. You can move the traditional. You can't move the Roth IRA. Now, this is the link that we sent that explains how those pro rata rules apply differently to a solo 401k versus an IRA. So hopefully that helps to recap. I think that's what you were asking me to recap. Oh, then we had another question from Maur. Maybe that's what you're also asking about. So he was saying, what year-end forms do I need when I fund my solo 401k? So no year-end forms from a solo 401k perspective when you make contributions, because contributions are not reportable by the plan. But there is a form that has to be issued for those mega backdoor Roth contributions, but it's not mega backdoor Roth contributions because really a mega backdoor Roth contribution is a two-step process. First, the contribution, then a transfer. So the contribution step is not reportable, but the transfer to the Roth account is reportable. So that's going back to that procedure page that I just sent with the after-tax to Roth transfer. You can see it's all laid out in that procedure page. Give you another chance to grab that. Hopefully that helps to clarify. Appreciate you bringing that up. So if I'm in my 60s, I can roll directly from my Roth bank account into my personal Roth IRA. Yes, because you would have met a triggering event. You'd be over age 59 and a half. And then here's the form that customers use to let us know about that Roth solo 401k to Roth IRA transfer to give us the information we need to prepare that 1099-R, because that is also going to be reportable when you go from a Roth solo 401k to a Roth IRA. Give you a moment to grab that link. Thank you so much for the great questions. We do appreciate it. Again, if you're finding this helpful on YouTube, if you'd like, that would be very much appreciated. It helps us get the word out. Okay, If there are other questions, please don't hesitate to chat them over as well. Going back to the $50,000 salary question, are you saying that one can max up to 50,000, but what can we do with these regular business earnings? So what I'm saying is that you cannot contribute more than 50,000 because you can't save more than your earned self-employment income. Now, if the wages are 50,000, got to look at the different buckets, right? For example, let's assume that the individual is under 50 years of age and they're trying to make 2025 contributions. They have $50,000 of W-2 wages from their self-employed business, and they're not contributing to any other plan, like a day job 401k plan. So they're going to be able to contribute $23,500 as an employee. They could also make an employer contribution of 25%. That'd be another $12,500. So that would take us up to 24 plus 12, 36. So now they've contributed 36, right, between the employee and the employer. So they still have another 14,000 that they could contribute, and they could make that $14,000 contribution as an after-tax contribution. We need to go into a separate after-tax account before it gets moved over to the Roth. So they'd end up contributing between employee, employer, and voluntary after-tax, $50,000 of contributions. Great question. Clarification. It seems that the mega backdoor Roth would be good for only those who are high salary earners because you have high income to be able to contribute. Well, as we just talked about, even with the $50,000 salary owner, they could still contribute a voluntary after-tax contribution. And let's say that they were only interested in making Roth contributions, right? They could contribute $23,500 as a Roth employee contribution, and then they could do the difference up to $50,000, right? So that would be another $26,500 if my math is right, as an after-tax contribution, then move the money over to the Roth account. So at the end of the day, they got $50,000 in their Roth Solo 401k, which is obviously much higher than they'd be able to contribute, for example, to a Roth IRA. No income limits. Like unlike a Roth IRA, if you have a high income, you can't make Roth IRA contributions. There are no such limits that apply to a Roth Solo 401k. Great questions. I have an S Corp with an income of 120,000. I take 90,000 in W-2. What is the max I can contribute to my solo Roth 401k, including mega backdoor Roth? Can you break down the numbers? Definitely. So let's assume we're talking about 2025. Let's assume the individual is under 50. Let's assume that they don't contribute to another plan, like a day job 401k plan. So they're going to be able to contribute 100% of the wages, dollar for dollar, up to $23,500 as a Roth Solo 401k employee contribution. And then they're going to be able to do the difference up to $70,000 as a voluntary after-tax contribution, then move those funds from the after-tax Solo 401k to the Roth Solo 401k. So at the end of the day, they have $70,000 in their Roth Solo 401k for 2025 based on those $90,000 of W-2 wages. Great question, great scenario. Do I need to report contributions to my solo 401k pre-tax account so I could get a tax break on my business income return? Yes, in short, one needs to report those pre-tax contributions because that's how you get the credit, right? That's how you reduce your taxable income. Now, if the business is taxed as an S Corp, there's two types of pre-tax contributions that could potentially be made. One is employee, the other is employer. So one's ability to make contributions to the solo 401k when your business is taxed as an S Corp is based on the W-2 wages. So let's assume that they have $100,000 of W-2 wages. Let's assume they're under 50. Let's assume that they don't make contributions to a day job plan. In that case, they could contribute $23,500 as a pre-tax employee. So that's going to reduce box one of their W-2. And instead, that $23,500 employee contribution will be reported on box 12 of their W-2. So box one would now be, my math is right, $76,500. So they would have reduced their taxable income by $23,500. So that's $76,500 is the income that gets carried over to the top of their 1040. Now, on top of that, they can make an employer contribution of 25% of their W-2 wages, specifically box 1 of the W-2, plus any pre-tax elected deferrals not in box 1, but over in box 12. So in other words, 25% of 100,000. So that'd be another 25,000. That would get reported on the 1120S to reduce that income, that business income, which will ultimately reduce the amount that flows through to them as the owner of the business. So in both cases, they're reducing the income, some as the owner, other as an employee. Great questions. The link you provided is entitled partial transfer. So if you're going to do the full transfer, let's grab that link. What is the max I could contribute for 2024 into my voluntary after-tax account? Well, one can contribute 100% of their self-employment compensation, dollar for dollar, up to $69,000 for 2024, assuming they don't make any other contributions to the solo 401k. So for a business is taxed as an S corp, for example, self-employment compensation is a W-2 wages. So as long as you have at least $69,000 of W-2 wages, you can contribute the full $69,000 as an after-tax. Most definitely. So let me see here. So if I can grab your email here. 1 second, please. So we'll follow up with you regarding going over the paperwork after this call. I'll have one of my teammates follow up with you. Thank you so much for the good participation. Thank you. As far as how do you watch the videos again, if you signed up, which you did, I can tell on the webinar page, if you go to mysolo401k.net/webinar, you can sign up. And then after we end the stream, an email will be sent to you where you can watch the recording. If you also subscribe on the YouTube channel, we also have them posted there. No, that's not right. They don't have to come from the personal or business. They can come from either. From a solo 401k perspective, you can transfer from your personal or business to make those contributions. Now, based on experience and client feedback, some of our customers, tax advisors or accountants, may prefer that employee contributions come from the personal and employer contributions come from the business from an accounting perspective. But we can't say from a solo 401k perspective that it has to be that way. All right. So then looks like that takes us to the end of the questions for today. We really appreciate the good participation. Thank you so much. Please continue to participate. Please like if you're on YouTube. Please subscribe. Again, please continue to participate. You can also participate 24/7 in our community. We'll be back again tomorrow, 10 a.m. Pacific, 1 p.m. Eastern, and then again in the afternoon. So we appreciate the chance to discuss these topics. All the best, everyone. Take care.